The economy is supposedly fine. Unemployment is still low. The stock market is near all-time highs. Jerome Powell keeps saying we're headed for a soft landing, and yet something doesn't feel right. Layoffs are quietly picking up. Companies are missing earnings. People are pulling back on spending. The vibes are off. So I built something to cut through the noise. A recession prediction model that tracks economic indicators in real time. And what it found is concerning. The model sits at 67 out of 100 on recession risk. That's pre-recession territory. And it's been climbing steadily for weeks. This isn't some random algorithm throwing around scary numbers. This is months of work, back-tested against every recession since 1970, calibrated to spot the patterns before they become obvious. And right now, it's flashing warning signs that most people are completely ignoring. What's up, guys? It's Tom here. And if you've been following this channel, you know we've been ahead of some big calls lately. We flagged Bitcoin at maximum risk back in December before it dropped over a third from its peak. Not because I hate crypto, but because the risk metrics were screaming danger. We called out the jobs numbers being fake months before the government admitted they overcounted by hundreds of thousands. People thought I was being paranoid. Turns out the Bureau of Labor Statistics can't count, and the defensive portfolio strategy we've been running has quietly outperformed the market since we launched it in January. Not because I have a crystal ball, but because I got tired of reading headlines that didn't match the data I was seeing. Every morning I'd wake up to CNBC telling me everything was great while my spreadsheets showed a completely different reality. So I spent months building this model from scratch, multiple indicators. Everything from unemployment claims to credit spreads to consumer sentiment, updated daily, back-tested against decades of economic data. And what it's telling me right now is that we're a lot closer to recession than anyone wants to admit. The scary part, the model has never been wrong about the direction when it hits this level. So let me walk you through how this thing actually works. Because I'm not just throwing around random numbers here. The model tracks two types of data. First, the core economic indicators, the big ones everyone watches: unemployment rate, GDP growth, yield curve, job creation. But here's the problem with those. They're lagging indicators. They tell you what already happened, not what's coming. It's like driving by looking in the rearview mirror. By the time unemployment spikes, we're already months into a recession. So I added a second layer, leading indicators. Things like credit spreads, consumer confidence, initial unemployment claims, housing permits, manufacturing surveys, stuff that moves before the recession officially starts. The model weights everything based on historical accuracy. Some indicators are better predictors than others. The yield curve inversion, for example, has predicted every recession for decades. It gets heavyweight. Consumer sentiment surveys are more noisy, so they get less. The model runs simulations on thousands of possible economic scenarios and spits out a score from 0 to 100. 0 means no recession risk whatsoever. 100 means we're already deep in recession territory. Right now we're at 67. That puts us in what I call the pre-recession phase. Not there yet, but all the conditions are building. And historically, once the model hits this zone, we've never avoided some kind of significant economic slowdown. And here's what the model is actually seeing right now that's got it so concerned. The labor market is falling apart. Not the headline unemployment rate, that still looks fine, but the stuff underneath is ugly. Job creation has basically stalled out completely. We're creating barely enough jobs to keep up with population growth. Companies have essentially stopped creating new positions. They're in full preservation mode. And remember, these are the same job numbers that were just revised down by massive amounts. The system that counts employment is fundamentally broken, and the real picture is probably much worse than what we're seeing. Then you look at job quality and it gets even scarier. Most of the jobs being created are part-time gig work or temporary positions, full-time employment with benefits. That's actually declining. Then there's the consumer, which is most of our entire economy. People are worried and pulling back spending, not because they want to, but because they literally have to. Credit card debt is at record highs. The interest rates on that debt are crushing, and wages, despite what you hear about wage growth, aren't keeping up with the real cost of everything. Housing, food, insurance, utilities, it's all going up faster than paychecks. That creates a doom loop. People spend less, companies make less money, companies hire fewer people, people have less money to spend. The model is seeing the early stages of that cycle right now. But here's the part that doesn't make sense and really concerns me. Market fear is spiking hard. The VIX, which measures how scared investors are, has been jumping around like a caffeinated squirrel. We've seen multiple days of serious concern, which historically means something is seriously wrong. Bond markets are acting weird. The yield curve is still inverted in places, which is recession territory. Credit spreads are widening, meaning banks are getting pickier about who they lend money to. Oil keeps creeping higher, which is never good news for inflation or consumer spending. And yet we keep getting told everything is fine. The disconnect is absolutely massive. Turn on CNBC and they're still pushing the soft landing narrative. Corporate earnings calls are full of optimistic guidance that doesn't match what's happening in the real world. The Fed keeps talking about more rate cuts like they're going to save the day, but the data underneath is telling a completely different story. Jerome Powell says we're going to avoid recession while jobless claims keep climbing. CEOs talk about strong consumer demand while their own sales numbers are falling. It's like everyone agreed to pretend the warning signs aren't there. And historically, this is exactly how recessions start, not with some dramatic crash that everyone sees coming, but with a slow deterioration that nobody wants to acknowledge until it's way too late to do anything about it. If you look back at previous recessions, and I spent weeks doing exactly this, the warning signs were always there months ahead of time. The housing crash didn't start with Lehman Brothers collapsing. It started years earlier with subprime lending problems that most people completely ignored. Housing prices were already falling in multiple markets. Mortgage delinquencies were rising, but everyone kept saying it was contained. Then it wasn't. The tech crash didn't begin dramatically. It started with tech companies burning through cash with no profits to show for it. The dot-com bubble had already popped, but people kept believing in the new economy narrative until it was obvious, even to the most optimistic investor, that it wasn't working. Every single time, the pattern is the same. The data starts deteriorating months before anyone calls it a recession officially. And by the time the National Bureau of Economic Research finally declares it, we've already been in recession for months. That's why I built this model. Not to predict the future perfectly. Nobody can do that, and anyone who claims they can is lying. But to spot the deterioration pattern early enough to actually do something about it. To position yourself defensively before everyone else figures out what's happening. So here's how I see this playing out, and I've run the numbers on all of these scenarios multiple times. There are really three paths from here. Path one is the soft landing everyone's desperately hoping for. The Fed manages to cool inflation without completely killing economic growth. Job creation magically picks up again. Consumer spending stabilizes as credit card debt gets under control somehow. Corporate earnings start beating expectations again. The model score drops back down to safer territory. That's possible, but it requires literally everything to go right at the same time. Interest rates have to be perfect. Inflation has to cooperate. Consumers have to stop being scared, and companies have to start hiring again. Historically, the odds of threading that needle are pretty low. Path 2 is what I call the slow grind, and it's probably the most likely scenario right now. We avoid an official recession because GDP doesn't go negative for consecutive quarters, but growth stays pathetically weak. Job creation stays at stall speed. Corporate earnings keep missing expectations. Consumer spending grows at barely sustainable levels. Markets stay volatile but don't completely crash. It's not technically a recession, but it feels like one for most people. This is what Japan went through, not a dramatic collapse, just years of economic stagnation that ground people down path. 3 is the one nobody wants to talk about, but that the model thinks has significant odds of happening. The labor market breaks completely and unemployment shoots up dramatically. Consumer spending collapses as people get scared and stop buying anything they don't absolutely need. Corporate earnings fall off a cliff as companies realize their optimistic guidance was completely wrong. And we get a proper recession that catches everyone completely off guard because they were too busy believing the soft landing story. The model's forecast is showing path 2 as most likely right now. Slow growth, high volatility, no dramatic crash, but no real recovery either. So what does this actually mean for your money and your life? Because that's what really matters here. If you're sitting in a basic index fund thinking you're properly diversified, you're essentially making a bet on path 1, that the soft landing happens and everything works out fine. Maybe it does, but the risk reward is getting really ugly. If the model is right and we get path 2 or 3, you're looking at years of flat or negative returns while inflation keeps eating away at your purchasing power. If you're carrying debt, especially credit card debt, this is absolutely not the time to be leveraged. Crushing interest rates will destroy you in a weak economy where wage growth slows down or stops entirely. Every month you carry a balance is like bleeding money. And if you're thinking about buying a house right now, mortgage payments are eating up an unsustainable portion of median household income. The model has housing affordability at extreme risk levels, meaning either prices have to come down or incomes have to go up dramatically. And guess which one is more likely in a recession? If you're in a job that depends on consumer spending, retail, hospitality, real estate, luxury goods, you need to be preparing for a tougher environment. If you work for a startup or a company that's not profitable, you should be updating your resume. History shows that unprofitable companies get slaughtered in recessions as investors stop believing in growth stories and start demanding actual profits. Look, I get it. None of this is what you want to hear, especially not right now. Everyone's tired of doom and gloom and bad news. We've been through enough over the last few years with COVID, inflation, market crashes, political chaos. People just want things to be normal again. They want to believe that we've figured it out and everything's going to be fine, but pretending the warning signs aren't there doesn't make them go away. It just makes you unprepared when things actually turn. I'm not trying to scare you or sell you gold coins or get you to panic. I'm trying to give you information that the mainstream financial media either doesn't have or doesn't want to talk about because it's inconvenient. Here's exactly what I'm doing with my own money, and I'm not asking you to copy me, but this is how I'm positioned based on what the model is telling me. I remain heavily defensive. A large portion in cash and cash equivalents, which I know sounds crazy in an environment where cash pays decent rates, but when the model is at 67 and climbing, preservation matters more than growth. I've reduced my equity exposure significantly, concentrated in dividend-paying companies with strong balance sheets that can survive a recession. No growth stocks, no unprofitable companies, no speculation. The remaining portion is split between treasury bonds, commodities, and some international exposure in countries that aren't as dependent on the U.S. consumer. This is the same defensive posture I've held since the model launched, and it's outperformed the market while taking significantly less risk. Not because I'm trying to time every little move in the market, but because when recession risk is this elevated, the math changes completely. If you want to track this stuff in real time instead of waiting for my monthly updates, I built a full dashboard. All the indicators updated daily, the forecast model, real-time alerts when the recession score moves significantly. Here's specifically what to watch over the next few weeks, because this is where things could accelerate quickly. If job creation stays weak, that confirms we're in economic stall speed and the model probably jumps higher, which is firmly in pre-recession territory. If market fear stays elevated, that's sustained concern, not just temporary noise. And if the consumer spending data keeps showing weakness, especially in discretionary categories, that's the final piece of the recession puzzle falling into place. The model will probably hit more dangerous levels if these things happen. And at that point, we're looking at serious odds of an actual recession within months.